What's up and welcome back. I'm Kellen Law and I'm here with my man Israel DeRay.
Hey, thanks for coming back to our channel. Today, we're going to be talking about a topic that, as a realtor, we get asked quite a bit. Normally, I get a phone call and say, "Hey, Israel, I love this house. Let's go see it." Right? So I'll take them out maybe for one visit just to see them, what they think of the house and all that stuff. But then the question comes out. I ask him, I say, have you talked to the lender? Have you been, pre-approved or pre-qual? And some of them say, yeah, I talked to the lender and all that. So I think today, maybe, you are the expert on this. So let's talk about the difference between being pre-approval and being pre-qualified.
Yeah.
So maybe give us an overall of that. Then we'll go into maybe, credit scores and debt to ratio income and things like that, which I know questions that I get asked quite a bit. So, yeah.
Because people love going to see the house.
Yep.
Nobody likes knowing how much that payment's going to cost. So it's natural for people to say, "Hey, Israel, let's go check out this house," and then afterwards say, "Oh, crap, we haven't seen what the monthly payment's going to be." So that's what I help with. Make sure that people are staying within their budget, and also make sure that they can afford it on paper. And that's what a pre-qualification and a pre-approval is. So to start off, pre-approval is pretty much like your report card when it comes to buying a house. It's going to break down your income, your debts, your credit score, your assets, and we determine what loan amount you can qualify for.
Yeah, and as a realtor, if I'm in the receiving side as a listing agent, so if I have a listing and then I get an offer on the house, the offer that I get from the other agent has to come with a pre-approval letter. And it makes a huge difference on that end as if we get a pre-qual to a pre-approval, because that means that you already went through, with your client, you went over through a bunch of other stuff and you got more information, because a pre-qualification, it probably can be done online by anyone, right? Because you put in how much money you make and some of your debt, and they'll say, well, you can be pre-approved for this amount. But the qualification comes at checking all the other documentations you were talking about, right? And making it a little more solid.
Yeah.
Am I correct? Okay.
Flipped a little bit. So pre-qualification is basically a verbal, hey, I make 200 grand or 100 grand a year. I've got this much in debt. I've got this much in the bank. And then I'm just kind of putting all the numbers together and say, yeah, it looks like from what you've told me, you'd be good to go. So that's a pre-qualification.
There you go.
It's a very loose go at getting pre-approved. So pre-approved is when we get your documents, we get your W-2s, your pay stubs, if you're self-employed or 1099, or you're doing a specific type of loan, we get your tax returns. We run all those to ensure that what you said verbally is backed up on paper. And so once that's done, then we'll send it to an underwriter to have them check out everything, and that is your stamp of your pre-approval. And so it gives an extra layer of security
100%.
when going to put in an offer, because just have a pre-qualification of, yeah, sounds like this guy's good, but you've got the official pre-approval with it.
And that's why you got to talk to the lender, you see, because I got it backwards. It's pre-approved, pre-qualification. So you want pre-approved, telling me, hey, this guy is almost 100%
right
into for what he's trying to buy, or the family, right? So
right.
Excellent. So thanks for clarifying that. So, and the second one will be, a lot of time is when I'm on open house, or I'm talking to a potential buyer, credit score. What's the credit score? Also, is it different if I'm a 620 to maybe 780 or something like that? Or
yeah, great question. So there's 4 main loan programs. There's conventional, there's FHA, USDA, and VA. And they all have their own requirements and what they'll accept. So conventional is going to be probably the most strict when it comes to qualifying for your debt to income ratio and credit. So we'll start with credit since we talked about that. Credit, they can go down into the 600s, but they're going to want to see some compensating factors, like that you haven't had a late payment for a while, that you've got a lot of money in the bank, you're putting a lot of money down, maybe you've got a cosigner that has a credit score in the 700s. So generally, just rule of thumb, if somebody's got a credit score in the 700s, they're probably good to go conventional. And then FHA is going to be, and VA are going to be the most lenient when it comes to credit. For FHA, I've got an approval down to 560.
That's good.
Which is they had to have a lot of compensating factors. 580, it's still like a 50-50 chance if it's going to go. Once we get into the 600s, we're feeling a little bit more comfortable. And that's similar with VA. They do have requirements. If your credit is in the low 600s or 500s, you can't have late payments in the last 12 months, along with some other factors. But rule of thumb, if you've got in the 600s, 640 plus, and then 700s, you're going to be in good shape. USDA, that's going to be around, if again, 640 to 660 and above, you're going to be in good shape for that.
And we can break this down next time, maybe like with USDA loans, FHA and conventional, something like that, because
there's
USDA,
a lot to
it is a
cover,
lot.
yeah.
But basically, if you're in the 640, 620 some plus, then you're good to go. And then the higher you go, the better
interest rate
you're going to get, and all that
right.
stuff. So yeah,
you got it.
And then the other one that I get is a question. Sometimes people read it on the internet or they find out, and it's DTI. And we know that stands for debt to ratio income, right? So, so how that affects the either the loan qualification part, or how does it affect the buying process, or what? Like what's that mean?
Debt to income ratio is super crucial when getting qualified for a home. For conventional, they want to see that you've got your at least 45% or less of your income is going to be going towards your home payment. So if you're making $200,000 a month and your home mortgage is $100,000, then that's going to put your debt to income ratio at 50% because half your income is going towards your monthly payment. And so that's a little bit too high for conventional. So they want to see it closer to about 45%. FHA can go up to 55%. So they're a little more lenient on that. But it also takes into consideration your debts that you have outside of your housing expense. So it'll take into consideration the education loans or credit card debt, installment loans, auto loans, anything that's going to show up on your credit, we're going to utilize, with the exception of often medical debt, we don't have to include.
Okay, good to know. So, and then the last one, and maybe we should start with that one, is a lot of people come to me sometimes and say down payment. I don't have 20,000 to put down in the house.
Yeah.
So down payment, just maybe a quick review. I know we can go on that rabbit hole probably for 2 more episodes on down payment.
Right.
But is it necessary to have, or do we have to have 20% down in order to buy a house?
Great question. The answer is no. You don't have to have 20% down. You don't have to put 20 grand down. You got to have a minimum, if you're going conventional, 3%. So let's say a house is 400 grand, then you have to have 12 grand for your down payment. And there are options to even put no down payment, either VA or USDA, and then some down payment assistance programs.
Perfect. Yeah. So we can talk. If you have questions about down payment, just comment below, reach out to us. We can go into the whole down payment situation, because each different program has different down payment, and every down payment, the loan has different requirements, and sometimes you can get no down payment whatsoever, but then that means you might not be able to sell your house for the next 2 years or something like that. So there's a lot that goes. Yeah, it's nothing is free. There's no free lunches.
Yeah.
So the information here is free, but that's about it. So
thanks. Thanks for joining us. We're glad that you were here, and we'll catch you next time.